In the last video, we talked about the Boeing stock and why you shouldn't have it in your portfolio. Despite not being able to foresee certain events, like losing parts in the stock then dropping significantly, today, we're going to talk about the other end of the spectrum, NVIDIA. NVIDIA reached a new all-time high on the same day Boeing had its setback. There are some interesting things that both traders and investors could have seen beforehand. First, let's take a long-term look at NVIDIA. It's amazing to see how this stock has performed. It went public in 1999, right in the middle of the dot-com crash, quite late. The dot-com crisis, also known as the dot-com bubble, was a period of extreme growth in the usage and adoption of the internet in the late 1990s. This era was characterized by a rapid rise in equity markets fueled by investments in internet-based companies. During this time, investors were eager to invest in any company that had a .com in its name, often without regard for the company's underlying business model, profitability, or realistic revenue projections. This led to massively inflated stock valuations. The bubble reached its peak in March 2000, after which it burst, resulting in many .com companies going bankrupt and trillions of dollars in investor wealth being wiped out. This crash was a significant event in the evolution of the internet and the global economy. Back then, before splits and so on, the NVIDIA stock would have cost 43 cents. Now, on Monday, it closed at $522. No need to talk about how outstanding that is for someone who bought it in these early years, although it's always had significant fluctuations. The trend looks very strong upwards, and as said, the stock has just hit a new all-time high. What's interesting for both traders and long-term investors? Let's start with the weekly chart. Many traders make the mistake of letting their emotions guide them too much, which is a normal process. Specifically with NVIDIA, there are always those who say they missed this rally, right? Back in October 22, it was only at $110, and then it rose a few 100%, one of the best stocks of 2023, the best stock of the Magnificent Seven stocks. The Magnificent Seven are the 7 big tech companies: Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla that far outpaced the performance of the other 493 companies in the S&P 500 in the recent years. Many weren't part of NVIDIA's race, and fundamentally, the stock is way overvalued, no matter which fundamental factor you consider. However, we've learned that most stocks that perform very well over years or decades are always fundamentally overvalued. What is an overvalued stock? Understanding what makes an overvalued stock is fundamental to navigate the stock market. An overvalued stock is characterized by its market price being higher than its intrinsic value. This intrinsic value is derived from a company's fundamental aspects, like earnings, revenue growth, dividends, and future prospects. When a stock is deemed overvalued, it suggests that the current price reflects an exaggerated market sentiment rather than the company's actual performance or potential. This overvaluation can be driven by various factors, such as investor speculation, industry hype, or even macroeconomic trends that lead investors to adopt an overly optimistic view of the stock's future performance. For example, a tech company like NVIDIA experiencing rapid growth might become the focus of intense investor interest. If this interest pushes the stock's price to levels that are not justifiable by its earnings or growth potential, the stock becomes overvalued. It's like paying a premium for a product based on its perceived future value rather than its current worth. One common metric used to assess overvaluation is the price-to-earnings (PE) ratio, which compares a company's share price to its earnings per share. An excessively high PE ratio compared to industry averages or the company's own historical PE ratios can be a red flag. However, it's important to note that overvaluation is not solely determined by PE ratios. It must be considered in the context of other financial metrics and market conditions. In essence, an overvalued stock represents a discrepancy between price and value, where the price is inflated beyond what the fundamentals justify. Investors need to tread carefully with overvalued stocks, as they are often subject to corrections that align their prices more closely with their intrinsic values. It's true whether it was Microsoft, Amazon, or even Tesla, where they say it's overvalued but still goes up. It's not just about PE ratios and such. You need to do more. To further explain the concepts of stock valuation and tools like PE ratios, I will be uploading more videos on these topics soon. Stay tuned and subscribe to my channel to make sure you don't miss anything. Also, feel free to write me about which topics around stock trading, investing, and market analysis you would like to learn more about. So, if you now say, hey, I believe this stock is too expensive, and therefore I might want to sell or take money off the table. You always have to ask if your expectation is the same as what the market is currently showing. The simplest way, of course, is to look at the trends. You all know how a trend should look, and as an investor, you should not just look at the daily charts, but rather at the weekly chart, maybe even the monthly chart. A trend is clearly characterized by rising highs and rising lows. Let's look at the NVIDIA stock as an example and see how the trend was here. We'll start in November 21, so we're going back quite a bit, and here we see a wonderful downward trend forming, marked by falling highs here and falling lows. This is a classic characteristic of downtrends. The lows get lower, and the highs also get lower. We also see here that at this point, after the stock had already gone down once, it went up again, then fell below the moving averages. We always look at either the 21-day or 30-day moving averages in the weekly chart. This moving average is just an optical signal, not an entry or exit signal. You can fine-tune it much better by saying, consider it like a traffic light. You could even take a 200-day average, which would be a 40-week moving average, and say everything above it is always long, everything below it is always short. And then we see how that changed. We had this low point, and then something happened. We went up, made a high roughly where the last highs were, but then suddenly overcame this high, and that was the end of the downward trend. The stock went up nicely. Look at what happened recently. The stock never really broke its upward trend. It never fell below its moving averages. It was a bit far from the moving averages, meaning it moved faster than a few weeks ago, so it went up steeply, came down, and then, for someone who is in for the long term and wants to make the big gains, you didn't have to sell this stock. You could keep it in your portfolio through this entire correction as an investor because the structure was completely intact. I'm not talking about a trader who focus on the short-term returns. It didn't matter what anyone else said. The structure was intact, it was never broken, and therefore you could stay in quite relaxed for a longer period. Despite the market correcting in the second quarter of 23, despite the market showing a little weakness in December, this stock continued to run sideways. And then, of course, came this breakout. Let's look at that. This breakout could have been traded with very little risk, even as a trader. If we look at this in a daily chart, we see this very nicely. The stock goes up, runs a bit sideways, and then comes this sideways phase. The volumes go down, and then bang, with great force, the stock breaks out. So for a trader, it was relatively easy to enter this stock and take something with them again. We can also look at a ratio chart, which is quite interesting. I showed you in the Boeing video how the stock behaves compared to its index, for example, against the Nasdaq. Let's look at that. We see NVIDIA against the Nasdaq, and we see that it was stronger all the time, and recently, it went sideways compared to the Nasdaq, even though the Nasdaq had fallen. These are all things that you can make very simple decisions about, even though you don't know what will happen. Again, it's not about knowing what will happen. No one can know that. Maybe someone can. I'll get to that in a moment. But in general, we're not insiders. We don't know anything. But you can always make plans, saying, if this happens, I'll do this, and if that happens, I'll do that. So, NVIDIA could have fallen, but as an investor, you would have known exactly where your story no longer holds, where you should get out. Or, as a trader, you would have known, okay, it's breaking out now, and if something happens that shouldn't happen, where do I take my profits? Where do I set my stop? And so on. Now, let's talk about insiders. There's probably an insider at NVIDIA, considered one of the world's best traders. No, it's not Cathie Wood, but rather Nancy Pelosi. Nancy Pelosi is in the U.S. Congress, and she's made fantastic deals on the stock market in recent years. For example, she bought NVIDIA, and 2 weeks later, a law was passed that provided NVIDIA with generous assistance. She bought Apple before certain laws were passed, and so on. This seems to be insider trading at its finest. However, one can track it and follow it. Nancy Pelosi made a trade on December 20th last year with options, a trade that has now brought her almost $2 million in profit with NVIDIA stocks. It was a brilliant trade, initially incomprehensible to many because they didn't understand options. But that trade has brought her $2 million in a few weeks and will probably bring much more. That's it for today. Write in the comments if you are an NVIDIA shareholder. If yes, great. If no, maybe you should consider it. But hey, we don't give advice. We just show you how money is made in the stock market. With that, we'll see you in the next video. Goodbye.